You actually read charts every single day without even breaking a sweat. Checking the weather, glancing at your battery percentage, or tracking your fitness steps, it's all visual data. Like if you see your phone battery dipping into the red, you instantly know to find a charger, right? Honestly, it probably induces a mild sense of pure panic. Or if your weather app shows a line trending down, you know it's going to get cold and you grab a jacket. Well, reading a stock chart relies on exactly the same instinct. It's really just a visual story. But for some reason, when it involves the stock market, we all tend to freeze up. A red battery icon causes immediate action. But a red line on a financial chart? Yeah, that just makes people close the app, look away, and pretend it doesn't exist. But here's the thing. The only real difference between glancing at your daily step count and looking at a stock's price history is that nobody has ever bothered to translate those financial squiggly lines into plain English for you. The finance industry loves its jargon, right? It loves to make things sound super exclusive. But beneath all of that noise, a stock chart is just data trying to communicate a very simple visual story. So in this explainer, we are going to fix that translation issue once and for all. All right, here's our agenda for today. First, decoding the squiggly line. Second, why candlesticks are just step counts. Third, spotting the bigger trend. Fourth, volume and who is paying attention. Fifth, floors, ceilings, and resistance. And finally, reading the whole story. Let's kick things off with Section 1, decoding the squiggly line. We're going to start with the absolute foundation here, stripping away all the noise, the flashy colors, and the confusing metrics. The absolutely crucial point to remember is that a stock chart is fundamentally just a historical record of what a company's shares cost as time ticks by. That's literally it. That is the entire secret. When you strip away all that Wall Street intimidation, you're simply looking at a picture of a price moving through time. There's no hidden math you need to do in your head, I promise. Think about it exactly like checking an app for gas prices. If you want to see if prices are climbing this week before you decide to fill up your tank, you naturally just check the trend. Well, the bottom of a stock chart works the exact same way. It shows time moving forward from left to right, whether that's days, weeks, or months, and the side of the chart, that just shows the price moving up and down. So that jagged line you see moving across the screen is just the price doing its thing over a specific time period. And honestly, grasping that alone is genuinely 80% of what you need to know to stop feeling intimidated. Moving right along to Section 2, candlesticks are just step counts. Okay, now let's look at the micro layer, those little red and green bars that usually scare beginners right out of the gate. These bars are called candlesticks, which sounds way more complicated than it actually is. If you just picture your phone's daily step tracker, a green candle simply means the stock ended higher than it started. It's just like a fantastic active 10,000 step day where you totally crushed your goal. On the flip side, a red candle means it ended lower than it started, exactly like a lazy Sunday where you barely left the couch. It's just telling you the net result of that one single isolated day. And the shape of it beautifully illustrates the full day's activity all at once. The thick part of the candle, which is known as the body, is strictly where the price opened in the morning and where it closed in the afternoon. But as we all know, the market bounces around all day, right? So those thin wicks sticking out of the top and bottom, they just show the absolute high and low temperatures the stock hit during the day. It is exactly like checking your weather app and seeing a high of 80 and a low of 60, even if the temperature eventually settles right at a perfect 70 degrees by 5 o'clock. Next up, Section 3, spotting the bigger trend. So now that you can confidently read what happens in a single day, we really need to zoom out. Think about the ratings for your favorite Netflix show, or honestly, just think about your own weight on a bathroom scale. A single daily wiggle up or down is completely meaningless compared to the broader trajectory. One red day on a stock chart doesn't tell you the whole story, just like a post-Thanksgiving scale anomaly doesn't ruin a year-long health goal. The overall direction matters way, way more than the daily noise. When you zoom out over a few weeks or months, you're simply looking to see if the overall story is climbing steadily, if it's drifting downward, or if it's just kind of parking sideways in place. Take a moment to really look at that trajectory, because that bigger picture is what investors actually care about. They want to know the direction of the momentum. They're looking for the tide, not just a random wave on a Tuesday afternoon. Which brings us to Section 4, volume. Who is paying attention? Now, what's really interesting here are those skinny bars at the very bottom of the chart. Beginners almost always skip right past them, but they are measuring volume. Think about a quiet neighborhood restaurant. If it normally has 1 or 2 customers a night, but suddenly there is a massive line out the door for a whole week, you instantly know something real is happening. Maybe they got a Michelin star or a food critic's review just went viral. That volume spike tells you a huge crowd of people suddenly care. Well, the skinny bars measure exactly this for stocks. They tell you how many shares were bought and sold that day. And this matters because context is absolutely everything. A price jump on a quiet, average day with low volume might just be a total fluke. It's kind of like a random 20-person birthday party wandering into that empty restaurant. Sure, it's a busy night, but it doesn't mean the restaurant is suddenly world famous. But if you see that exact same price jump paired with a massive volume spike, oh yeah, that means real news, real momentum, and real money is flowing in. The crowd has arrived and it is actively demanding your attention.
Section 5. Floors, ceilings, and resistance.
Next, we're going to add the boundary layer so you can see where prices generally get stuck. Have you ever tracked flight prices for a vacation? It's a universally understood frustration, right? You've probably noticed the price keeps bouncing around a very familiar range. It drops, hits a certain low, and bounces back up. It climbs, hits a certain high, and drops back down again. Well, on a stock chart, we call this support and resistance. Support acts as a floor, like a comfortable cushion that the price bounces up from. Resistance is a ceiling the stock climbs to, but keeps hitting its head on, struggling to break through. Now, it's absolutely crucial to know that these floors and ceilings aren't magic. They can definitely be broken, just like a flight price can completely skyrocket the minute a holiday weekend approaches. But spotting these levels visually shows you exactly what price zones other investors are paying really close attention to. A stock chart is basically a giant mood ring for millions of investors who are all trying to make the same decision at the same time. It tells you exactly where the collective market is mentally drawing its lines in the sand.
Finally, Section 6. Reading the whole story.
Okay, let's pull all of this together into a practical Tuesday morning routine so you can see just how fast and seamless this becomes. Imagine you're making your morning coffee and you pull up a stock chart. In the exact same 15 seconds it takes you to decide if you need an umbrella today, you can sweep this entire chart. 3 seconds to zoom out and confirm a sunny upward trend. 6 seconds to note that yesterday's candlestick was solid green. 10 seconds to look down and see a massive spike in volume, meaning big news is brewing. And 15 seconds to notice the price is testing that resistance ceiling we just talked about. Boom, you've just read the entire story of the market in 15 seconds flat. But look, before you run off to conquer the financial world, you always have to remember this vital caveat. Mastering this visual skill does not predict the future. Charts are not a crystal ball. Actually, scratch that. They're much more like a rearview mirror. They do not tell you what to buy or sell tomorrow. They simply tell you exactly what has already happened and how the market is reacting right now. They turn utter chaos into a readable history. This visual foundation is what all investing builds on top of. By translating squiggly lines into everyday concepts like step counts, gas apps, restaurant lines, and flight prices, it entirely removes the fear. It empowers you to approach financial data without the intimidation, putting you firmly in the driver's seat of your own understanding. So, now that you know how to read the visual data and understand the market story at a glance, the real fun begins. Stick around for our next explainer, where we're going to put your brand new skills to the ultimate test. We're going to find out if the most talked about stock in America right now actually has the business fundamentals to back up its wild squiggly line, or if the hype has entirely left reality behind. See you then.